As you know, healthcare and benefits can be complicated, which can make the enrollment process confusing. As part of that enrollment process, employers often offer ancillary benefits like basic and voluntary life insurance as well, but unlike health coverage, not everyone needs all ancillary benefits. So, what is voluntary life insurance? In this episode of HR FAQ, I'll answer that question and explain what options are available as well as who might need the extra coverage. Let's dive in. What is voluntary life insurance? All life insurance, including basic and voluntary, is an agreement between an insurer and an individual that requires the insurer to pay out a cash benefit upon the individual's death in exchange for a monthly premium. Voluntary life insurance is an optional employee benefit that supplements employer-sponsored basic life insurance. So, to better understand voluntary life, let's first quickly review what basic life is. Basic usually refers to the term life insurance offered by an employer who typically pays all or most of the relatively low premiums on behalf of their employees. If the individual dies during the term, their beneficiaries are entitled to a death benefit, a tax-free lump sum of money, usually without restrictions on how it can be spent. For more information on basic life insurance, check out our previous video devoted to the topic. The death benefit of most basic life policies is typically a fixed amount between $50,000 to $100,000, or occasionally a multiple of an individual employee's salary. While basic life policies are beneficial, they're often insufficient for the needs of many employees, which is where voluntary life comes into play. While an employee can look for supplemental coverage on their own, they'll likely pay higher premiums on the individual market. Employers can obtain lower premium rates by grouping employees together into the same plan. Paying voluntary life premiums is also more convenient than paying a retail plan's premiums since the employer often deducts the amount from the employee's paycheck. What options does voluntary life insurance offer? Voluntary life insurance usually offers more flexibility and options than basic life alone. For example, both basic and voluntary policies have guaranteed issue amounts, which is the most coverage an individual can get without completing medical questionnaires and exams as evidence of insurability in order to qualify for coverage. But with a voluntary policy, an employee may purchase additional coverage above the guaranteed issue amount, keeping in mind that evidence of insurability requirements may apply. Portability is another option that many voluntary policies offer that basic policies do not. This means that an individual can take the policy with them if they leave the employer. Of course, when porting the policy, the individual is responsible for paying the full premium on their own and on time. Most basic life insurance only comes in the form of a term life policy. In other words, an individual is only covered for a certain duration of time, typically 10, 15, 20, 25, or 30 years. Some voluntary life insurance, though, is available as a permanent life policy, such as a whole life and universal life, which can cover an individual for the duration of their life and can even build cash value. Who needs voluntary life insurance? The basic life death benefit alone may be enough for a younger employee without dependents to cover funeral expenses or other obligations. Even though there's rarely a reason to deny employer-sponsored basic life insurance, especially if it's at no cost to the employee, it's likely that older employees with families to support may need more coverage with voluntary life. How much coverage each employee needs can vary widely based on their situation. Common financial advice recommends 10 to 12 times an employee's annual salary, but that simple calculation may not reflect the unique need of the individual. The DIME approach takes those unique needs into account. In order to calculate the best coverage amount, the individual should consider the 4 DIME factors: debt, income, mortgage, and education. As a result, the death benefit they elect should allow the beneficiaries to pay off existing debt such as credit cards, student loans, and mortgages, as well as replace their income for a certain number of years and save for the educational expenses of surviving children. As I mentioned, basic life insurance may be enough for some employees, but it's critical that each employee choose the right coverage for their situation rather than simply depending on basic life alone. That's it for this HR FAQ. If you want to learn more HR best practices, subscribe to our channel and ring the bell to get notifications about the latest HR Party of One and HR FAQ episodes. As always, thanks for watching.